to do now that we've covered the basics of everything is you all know that there was a new tax act that was enacted July 4th, 2025. And that brought changes, some of them retroactive to 25, and that's what's real important. I'm going to focus on here that we will need to know as we're preparing the 25 returns. But then there's others that you've heard about, and our clients will have heard about them too, that really don't start till 2026. So we're going to need to be aware of those so that we can help explain to our clients and prepare them for the 26 tax year. So I'm going to share our presentation for here, and I'd like to give a shout out to Gene Gisa King, who is one of my colleagues that works for City of Phoenix and their VITA program, and also for AARP. He's put together most of these slides, and most of these slides came from Knoxville, Knox County VITA program that we attended this presentation back, I don't know, sometime in August, or right as this done. Now, of course, we've been editing these slides as we go because new information keeps coming out. So stay tuned, there still will be changes. So just to give you a little bit of background, there was the Tax Cut and Jobs Act of 2017, sometimes that's the Trump Tax Act in his first term, and that significantly changed the tax codes. However, those provisions were temporary, and they were going to expire at 2025. Most of you know the big change was the doubling of the standard deduction and removal of the exemption, right? That was due to expire at the end of 2025 if they didn't enact this tax act, which they did, and they called it the One Big Beautiful Bill Act. We kind of affectionately refer to it as OB3. And that brought back most of that kept most of those changes, and while making some additional changes. Most of these changes will take effect on January 1st, 2026, but some will affect the 2025 tax returns. And we've organized this presentation into those sections of when they're going to affect. So here were some of these, and I won't explain a lot of this, right? But these are the tax bracket thresholds. The only reason I really put this up, and I want you to really recognize this, most of ours in a VITA site, we have like a $69,000 limit. So most of our taxpayers are going to be in the 12 and 22% range. So what does this mean though? This is what's called a progressive tax schedule. It means the first 11,000, that's for single, call it 12,000 of income, is only taxed at 12%. But then the next range from 12,000 to 48,000 is taxed at 22%. Why do you need to know this? You don't need to memorize this. TaxSlayer will do it. But sometimes that taxpayer will be sitting there and say, hey, yeah, I just got a $10,000 raise. How's that going to affect me? How much tax am I going to owe next year on that? Well, if he's already at, $35,000, that 10%, that $10,000 rather, is going to get taxed at 22%. So he's going to owe an additional $2,200. So what are you going to advise him? Hey, go make sure your W-4 is correct, that they're withholding enough so you don't end up with a big bill next year. So that's kind of why we put that up there. Here are the standard deduction, and we already went over this in our presentation on deductions, but here's a reminder of what they are. And again, just an additional reminder, remember our 4012 is incorrect. They've got the wrong standard deductions in there. And I advised you in that to go into your 4012 and cross it out and put these accurate ones in there. Then the earned income tax credit's going to increase. And the maximum income level is right here, 68,675. That's usually what sets our limit for VITA. That's why we say we're going to help people with incomes below $69,000. So just some terminology, right? Some of these changes were permanent, that they won't expire. Like, for instance, the Tax Cut and Jobs Act in 2017, most of those provisions expired. They were temporary. They expired at 2025. Of course, even though we might say it's permanent, of course, Congress can go in there and change it at any time that you can get all of them to agree on anything. Um, so here's the first big change, and we will see a lot of this here, right? Is reduced taxes on tips. So taxpayers will be allowed to deduct the first $25,000 in income earned from customary tips. And IRS has published a list of that. I'm not sure if TaxSlayer will have that, but it's a pretty easy list to find. The, the easy thing I would tell you, our VITA clients, almost all of them will qualify under this. And the kind of work that they're doing, you know, unless they're in something what IRS calls a specified service trade or business, it's not likely, right? Most of them are going to qualify for that. However, look at this point 2 right here. Tips must be reported on W-2 or Schedule C, or there's another form if they were to come in and report, say, here, I made cash tips that I didn't report to my employer or whatever, and they're an employee, not an independent contractor, right? Otherwise, you would put them on Schedule C. But if they're an employee and they say, yeah, I made some additional tips I didn't report to my employer, we can put them on a form. I forget, it's like 4174 or something like that. But then they're going to pay Social Security and Medicare tax on those tips. They probably won't pay income tax because of this deduction right here, but they are going to pay 15.3% for that. Now here's tip 3, point 3 right here is very important. Mandatory service charges do not count. When you go into a restaurant and they say, well, for parties of 8 or more, we're going to tack on a 22% tip or whatever. That does not count because that's not a voluntary tip by the client, right? It's mandatory. Okay. The deduction phase is out at certain incomes. Of course, that won't affect us in a VITA thing. And this is a temporary thing. It's going to expire after tax year 2028. And a Social Security number is required. Okay. And contrary to media reports, and this has to do with a lot of these kinds of deductions, they are not an above the line deduction. Now, what do I mean by that? You might remember back when we started talking about income, I put together that tax formula that says income minus adjustments equals adjusted gross income, and that's the line. Adjustments happen above the line, and then deductions happen below the line. And AGI is an important number that's used in many other forms, like when you apply for student financial aid or other things like that. They ask for adjusted gross income. So that's why that's kind of important right here. Now, here's the second provision is reduce taxes on overtime. So they'll be able to deduct the single people the first 12,500 of income earned from overtime. Now, what is overtime? Overtime is that half portion of the time and a half. When they work more than 40 hours a week, right? And they get paid time and a half for that, the half portion is what we're talking about here. Now, how are you going to know that? Okay, well, in 2026, they're going to redo the W-2 to where it's going to say that in a box somewhere. But for 2025, IRS said, well, we don't have time to change our W-2s. So they've told employers, we would like you, actually, they mandated it to the employers. You have to give the employee a statement that specifies how much of their tips were included in box 1 of the W-2 wages, and also how much overtime was there. Now, the bad thing about it is, yeah, they mandated it to employers, but there's no penalty if they don't, right? So larger employers are going to do that. I'm not sure about the smaller ones if they will. And if they don't, and the client comes into the VITA site and says, well, yeah, I've got, all this here, this portion of my wages were tips. The employer didn't give me a statement, right? Well, again, this is kind of like all of those other Schedule C expenses and charitable contributions. We're going to tell the taxpayer, here, I'm just here to put in what you tell me. And at the end of this process, you're going to sign a statement that says, this is all true. And if you ever get audited, you're going to have to prove it. Okay, they'll ask you for documentation for whatever you claim here. So, I mean, we're not auditing them. We're going to take them at their word unless it's just unreasonable. And then you're not required to do a return if you really don't think the taxpayer is being honest with you. Okay, so again, this is a temporary one through 28. Got to have a social security number. And then again, just like the tips, this is not an above the line deduction. Okay. Here's a third one. It's reduced taxes on car loans. In other words, you can deduct some of the interest on the car loan. You might remember if you watched all my previous videos, I talked about the Tax Act of 1986 that took away the deduction for all personal interests. That would be like on car loans and credit cards. And that's when people started taking off in home equity loans. Well, now this act has brought back that you can deduct up to $10,000 of car loan interest as long as it's an American-made personal use vehicles. This isn't for businesses for that. It's just for personal use. You had to have purchased the vehicle after January 1st, 2025, and it has to be new. Used vehicles don't count. Okay. There's a phase out, once your income gets, higher. Again, that shouldn't affect our VITA clients, but it would phase out. This deduction, this is again on the car loans, is authorized through 28, not indexed for inflation. You must have a vehicle identification number. And it's supposed to come with a qualified interest statement supplied by the lender. That's who's ever, it's not the dealer. The dealer's not going to do that. This is like the bank, the credit union, or maybe, like GMAC financing, or, the lending arm of the automotive company. That they'll supply you with a statement, and the VIN should be on there. If for some reason you can't find the VIN, there's a VIN decoder website from the National Highway Traffic Safety Administration, and that you could find out, put in your vehicle information, and you could get it. Here we go. Additional senior deduction. Now, many of you maybe have heard during the campaign, hey, we're going to get rid of the tax on Social Security, right? As we discussed in our, when we talked about income, that your Social Security is not taxable until your other income hits a certain amount, and then 50% of your Social Security becomes taxable. And as that other income goes higher, up to like 34,000 or something, then 85% of your Social Security is taxable. Nothing changed about that. Despite, I'm on Social Security, I got a letter from the Social Security Administration that said, hey, this new tax act is going to take away the tax on tips. I'm sorry, the tax on Social Security. It does not do that. Let me repeat, it does not do that. Nothing has changed about the tax on Social Security. What they did to mitigate the tax on that is they put in a bonus deduction of $6,000 if you were 65 by December 31st of 25, whether you're collecting Social Security or not. You might be delaying your Social Security till you're 70. You're still going to get this $6,000 deduction. And it would be $12,000 if both spouses are 65 or older. How about the person who takes Social Security early at 62 and ends up paying tax on it? He doesn't get this $6,000 deduction. It really is completely separate from Social Security. So, when you're sitting down with a client, especially after you've done their return and you're going over their return with them, and they see they're paying tax on Social Security, they're probably going to say, no, you made a mistake. They told us there's no tax on Social Security, and you're going to have to explain this to them calmly. Okay. The deduction will phase out at higher incomes. And again, this is temporary. It's only authorized through 2028. It's not available if you're married filing separate. Again, I talked consistently through all these training videos that married filing separate is not a good filing status to use. This is kind of a chart that is showing you, if what your income would be, what the deduction, what tax savings would be at that level of income. Um, it does not eliminate Social Security tax. So enough said. So here's what uh, page one of the return would the new return would look like. So here's somebody who had $52,000 of income. And now remember line 10, this is the adjustments to income, right? This would be remember what we called above the line before we get to adjusted gross income. Right? So let's kind of look at a couple of things. So the adjustments to income come from a form. It's a Schedule 1, Part 2. And these adjustments to income, you'll probably remember when we went over these things like educator expenses or health savings accounts or self-employment tax, the deductible portion of that. These are all things that show up on this form, Schedule 1. Okay. Um, I will reiterate, and then when you, again, this is on that page 2 of the 1040, all those adjustments to income would come in right here. So it would reduce your adjusted gross income if you had adjustments up here. Okay. Here's what the new 1040 looks like. This was a draft form of it. I think they may have finalized it by now, or they will soon. For all of you returning volunteers, you'll see that it looks a little bit different, but it's basically got the information. It kind of put dependents and then started asking all these questions. For the new volunteers, all you have to do is fill out the basic information and the information of dependents, and TaxSlayer is going to check all these boxes for you. Okay. Here is the bottom part of page 1, and this looks pretty much like the tax returns have for the last several years. Okay, we get down here to the bottom, we get adjusted gross income, and then as we turn the page onto page 2, it starts with adjusted gross income. But now we're going to see another line down here. Okay, so here we've got standard deductions there, but now we have this 13B, additional deductions from Schedule 1A, line 38. That goes right there. So what is this Schedule 1A now? Well, and this is the rest of the page 2. But here's the new, this was a draft form. I'm not sure that they finalized it yet, but this was Schedule 1. This is Schedule 1A. Schedule 1A starts with a calculation of modified adjusted gross income. And that term you've seen all through the tax code, and it's a different calculation for different parts of the tax code. The one you may be familiar with is that calculation for Social Security, right? Where it says, okay, your MAGI is take half of your Social Security added with your other income, and that comes to be your modified and tax exempt interest. That's your modified adjusted gross income. This thing, this is add stuff from Puerto Rico. I think a lot of these are like foreign tax credits, probably none of which will affect our VITA clients. Their AGI is probably going to come out to be their modified adjusted gross income. But see, then now we get to part 2, and this was going to be no tax on tips. That's not entirely true. It's no tax on tips up to a certain amount, but nevertheless, don't let my cynicism get in the way of this here. This is going to be good for a lot of, especially our clients that are working. Then we get part 3. This would be the no tax on overtime. That was that second one that we talked about here. So part 3 of Schedule 1A will be generated here. Then part 4 is going to be that no tax on car loan interest, right? And then part 5 is where we're going to get that $6,000 deduction for seniors. And then part 6, they're going to add them all together right here and say, go put these over on line 13B of the Form 1040, right? So then we go back here to the 1040, and all of those additional deductions are going to come here. Again, below the line, right? So these are the 4 changes that are going to be in effect for 2025 that you need to be familiar with, right? the additional senior deduction, and you're going to need to explain about the Social Security, the tax on Social Security, taxes on tips. Hopefully you're going to see a statement from their employer that tells them how much of box one wages. See, when at the end of the night, they usually report to their employer what their tips were. That way they're included as part of wages and taxed for Social Security and Medicare. But the W-2 doesn't specify that, and it still won't for 2025. They're going to need a statement from their employer, or they needed to have kept a record of their own tips so that they can tell you. Same thing for overtime. And here's for car loans. All of these are below the line deductions, right? What do we care about that below the line? Because a lower AGI has many benefits. It can increase your eligibility for tax credits, because tax credits are quite often based on what your AGI is. It can boost other deductions. We talked about some itemized deductions that are like medical expenses that are subject to 7.5% of your adjusted gross income, meaning that you can't deduct the first 7.5% of your AGI. Well, if your AGI is lower, then that threshold is lower too. Other financial scenarios where, oh yeah, for the Affordable Care Act, it will affect those types of things, or the FAFSA form for financial aid for students, or sometimes for higher income folks, their Medicare premiums could go up if their AGI is too high. Okay, other changes for the 2025 tax year. Okay, we have an increased child tax credit. It used to be $2,000. Now it's gone up to $2,200. And I believe that this is going to be indexed for inflation. So we should start seeing an increase. Now, up to $1,700 of that will be refundable. Remember, the child tax credit was a non-refundable credit, but up to $1,700 would be refundable. And this is unchanged from 2024. And in our presentation on partially refundable credits, we talked about how you would calculate the additional child tax credit. That's what this is here. Future tax credits will be indexed annually to inflation. That's what I thought up here. And Social Security numbers are required for the child, which was unchanged. But this is a change. At least one parent has to have a Social Security number. Okay. The clean vehicle credits, those went away. Those went away as of September 30th, 2025. So preparers should know that. I mean, if they come in, and I think most people, if they went and bought a car if they bought an electric vehicle after September 30th, they're going to know they lost out on a big credit. These things are out of scope for us anyway, but you may have a taxpayer come in and maybe they did buy a car before September 30th. Have the site coordinator talk to them. Okay. Third-party network transactions. These are the 1099K rules that you heard about, and they've been going back and forth. Prior to 2021, before the Inflation Reduction Act, they only issued 1090, or they only were required to issue 1099Ks if the amount of transactions were over 200 and they exceeded $20,000. Now, when I say transactions, these are like credit card transactions. So like Uber and Lyft drivers, we used to see 1099Ks and they didn't meet this threshold. Uber and Lyft just decided to issue them anyway. But things like eBay and Craigslist, and that if you do a lot of transactions on eBay, they're supposed to send you this form so that IRS can track to make sure you're claiming taxes properly on it. Well, that was the history of it. And then when they realized in 2022, they reduced the amount down to $600, and everybody was freaking out because Venmo and Zelle and those cash things would be subject to these rules. And hey, you're sending money back and forth to help your friends pay for restaurant bills and sending money to your kids in college. And well, now are you going to be getting these 1099Ks and have to explain on your tax return that, hey, this wasn't a taxable transaction? So IRS came in, they said, oh no, okay, we're going to make it a much higher limit for 23, then reduce it down in 24. And then their intent was to get it to that $600 level by now. But now this changed everything and put it back to this level here. Now, all of these folks have programmed their systems. I suspect, just my opinion, that you're still going to see a lot of these 1099Ks. It doesn't change anything because if there was income, the taxpayer is supposed to report it, whether they got a 1099K or a 1099 NEC or a 1099 miscellaneous anyway, right? But now it will at least prompt us to ask them questions about how they generated this money and whether it's taxable or not. Here's another one that was for 2025. Back the Tax Act of 2017 put a cap on state and local taxes, SALT, right? This is your income taxes being withheld for state, right? Your property tax, vehicle tax that you might have paid, those taxes, they were limited to 10,000. Didn't really impact most of us here in Arizona. We have kind of lower property taxes and income taxes. But like California and the East Coast, a lot of those folks, they were capped out at 10,000. Now they've raised that cap to 40,000, at least until 2029. There's some scaling back of it if you've got really high, high income, won't affect us too. And then starting in 2020, 30, it reverts to 10,000, unless Congress comes in and does something, which, chances are they could. Okay, so, here's a big one. Okay, and this is partially for 25 and partially for 26. This is the Trump savings account for children under 18. So the first part of it says the federal government will make a one-time $1,000 deposit for every child born between 25 and 28 who is a U.S. citizen. They're going to just give them a starter account, right? And then parents can then contribute up to $5,000 annually. And then it has to be invested in a U.S. stock index like the S&P 500, or there's a variety of them. It doesn't have to be that one, but it has to be a stock index. And then the idea is that money can grow and grow and either be used for college expenses or converted into a retirement account as they get older. Employers can also contribute $2,500. But that would reduce the 5,000 maximum limit. And then you all may have heard, like Michael Dell is going to contribute some. This is still up in the air. Don't count on this yet because there was some technical problems with this when he was trying to designate it for only those counties that had incomes below $150,000. But keep tuned. Maybe that's going to be, there's other philanthropists that, want to contribute and do this. So that. Now, when you go to take money out of it, they're going to be taxed kind of similar to an IRA account, although this will get complicated. I'll save that for later, but mainly, okay, I'll speak to it now. So, like that $1,000 that comes into it, right? That was, you never pay taxes on that. So when that comes out, it's going to be fully taxable. But if your parents are starting to put money into it with after-tax money, then we're going to have a portion of it contributes to the basis in that account. The earnings are always going to be taxed, but then you start taking withdrawals and maybe a portion of it won't be. They have not finalized any kind of rules on this yet. And by the way, you can't take any money out of it for a long time anyway. So it's going to be a while before we see rules for that. Parents can contribute up to $5,000 annually until the child turns 18. Now, here's a big one. No one may contribute to the account until July 2026. So why do we even care about it, right? Well, you're going to see in a moment that there's a form to where they can elect to establish the account and elect to get that $1,000 contribution for the kids born in 2025 or 2026. Charities will be allowed to make broad contributions, state, local governments, and charities. The money cannot be withdrawn from the account until the year that the child turns 18. After 18, it functions kind of like an IRA, which means withdrawals for education expenses or first-time home purchase would not, uh, um, this says, or after 59 and a half can be without penalty. But if you take it out early, it would be subject to a 10% early withdrawal penalty, right? Unless it's used for education, first-time home, or there's that emergency clause too, that where it could be used for. All the funds must be withdrawn by age 31. Now you say, how's that a retirement account? Well, I think what this means is they want you to then convert it into an IRA. You'll roll it over into an IRA. So parents can elect this benefit via simple IRS form. And that form, the draft forms have been released now. So I think we're going to see these in 2025, and we're probably going to be asked to prepare them. Okay, they would not be subject to a tax offset, garnishment, or repayment. They've got to have a social security number. And I really don't understand how this is funded through 2034 but nevertheless, that's kind of what the law said. Okay, now they have put out a draft publication 590A, which was part of IRA contributions. That was released October 31st. And it says that there's a new 4547. I'll show you that form in a minute. And that's required to elect, one, to establish the account, and then two, to receive the $1,000. So like you can establish the account and then the parents can start putting money in. However, not until July of 2026, right? And then of course, if the baby was born between 25 and 28, then secondarily, they can elect to have that $1,000 put into the account. So and although my slide says the instructions have not been published yet, they were published about 10 days ago, and they were very confusing and actually contradictory. They're in draft form, so you just got to stay tuned. Before we get going into tax season, we'll know what to do with these. And so your site coordinator or whatever will help you figure this out. Just to give you an idea of how valuable this is, right, for a child that's under 18, it's a pretty good deal. Because if you look at the average annual rate of return for S&P 500 index over the last 30 years, right, it's around 10 to 10.5%, including reinvesting the dividends, right? If you have $1,000 in a retirement account at age 18, how much would it be worth at age 67 if the average rate of return is 10.5%? Just that $1,000 will be worth $109,000 at age 67, assuming that average rate of return, and no further contributions or withdrawals over the period. So this is the time value of money, and it's really powerful. Okay. The only caveat to that is a Big Mac will probably cost $1,000 by then too, but nevertheless, this gives them a good starter account for retirement or for higher education. I've had in live presentations of this, somebody said, well, isn't that like a 529 account? No, a 529 account is different. It can be set up and it can pay other educational expenses that you can't use IRA money for, like room and board and stuff like that. They should be two separate vehicles. 529 is a better vehicle for education. This would be if nobody ever was to set up a 529 and the child wanted to go to college and there wasn't any other funds available. Here would be a resource for them. Okay, let's talk about the changes that will occur next year in 2026. First of all, they've issued a draft of the W-2 that will happen at the end of 2026. And in this draft, there's going to be extra codes in here. I will show you what these are. The box 12 codes, I know you can't read all of these. It's okay. I'm going to kind of go over here where they added all these codes here, TA for contributions to your Trump account, total amount of cash tips, total amount of qualified overtime. um, occupation codes for tipped occupations. I think this year we will probably have to put the tipped occupation codes, but I'm hoping TaxSlayer will have those incorporated. Still too early to tell. We're going to see what they have coming out. So as I said, here are the three codes here that we'll need in box 12. Of course, there will no longer be any energy home improvement credits. There won't be any residential clean energy credits, even though that was out of scope. These weren't out of scope, things like water heaters and windows and doors, but they all expired after December 31st, 25. So those are gone. Here's what's new. And then, by the way, you're probably going to have clients that come in that give you all their charitable contributions. And, there's been all these social media accounts and news things that aren't necessarily clear that the additional deductions for charitable contributions, in addition to the standard deduction, the additional contributions don't take effect until 2026. But in 2026, even if you're taking the standard deduction and you're not itemizing, right, you'll be able to deduct up to 1,000 for single, 2,000 for married filing jointly of charitable contributions. Another change with charitable contributions, again, beginning in 2026, not for 2025, is there'll be a threshold, kind of like if you're itemizing donations, there'll be a threshold similar to like medical expenses. So only the donations that exceed 0.5% of the taxpayer's AGI will be deductible. Now, this is a deduction that was authorized permanently, again, until Congress changes it, but they don't expire like some of those other taxes on tips and things like that. And this, contrary, is an above the line deduction. Mortgage insurance premiums will come back beginning in 2026. That's been on again, off again. And so this is going to return in 2026 to where you can deduct mortgage insurance premium on qualified mortgage interest. Again, this is supposedly permanent. The ones prior have only made it for a certain year. It's usually kind of like a tack on to any legislation that's been happening. Miscellaneous deductions that are subject to 2% of AGI, meaning the first 2% of AGI wouldn't count. These were suspended by the Tax Cut and Jobs Act, but now they are permanently excluded. And these are the things many of you may not even remember. This is going back to before 2017, but we used to take safe deposit boxes or investment expenses, our tax prep fees. We could deduct moving expenses, but those have been eliminated now except for military. And then this year they added on the intelligence community. Those guys will still be able to deduct moving expenses. And then employee non-reimbursed expenses. During COVID, when everybody was working from home and they were saying, well, yeah, my employer required me to work from home. Well, prior to 2017, that may have been a deductible expense for them, but the 2017 Tax Act took away that. And now the new Tax Act here, the OB3, made that takeaway permanent. There will no longer be any employee non-reimbursed expenses. Gambling losses, here's a new one. Now, again, this is beginning in 2026. Now, you've always been able to deduct gambling losses up to the extent of gambling winnings, okay? And you'll still be able to deduct 90% of those losses against your gambling winnings. But again, that's only if you itemize deductions. Increased dependent care exclusion, again, beginning in 2026, you'll now be able to exclude up to $7,500 of dependent care. And this would be on your W-2, where your employer, where you've got a flexible spending account or something like that. you can exclude up to that. Now, then there will also be an enhanced dependent care credit. So that would start at 50% of eligible expenses, which that's up from 35% now. And then it's reduced by 1 percentage point for every 2,000 that the adjusted gross income exceeds $15,000. That's no change. And I know this may sound confusing to you, but again, this is a calculation that TaxSlayer does, so you don't know it. But the credit cannot drop below 35%, which used to be 20% in 2025. Lots of folks here in 2025, they're paying for dependent care expenses. A lot of them, their income gets up and they're only really deducting 20% of those costs. That's going to increase to 35%, a minimum of 35. It'll be between 35 and 50% of eligible expenses. Increased 529 limits and definitions. So now the K-12 distributions, now this would be if you're taking money out to pay for private schools, right? That's increased from 10,000 to 20,000. And then you could also withdraw money from there for tutoring, testing, dual enrollment. Dual enrollment is when high school kids are taking college courses. You'd be able to take out of that. And then this is a big one, post-secondary credentialing, including supplies for like certificate programs. They're doing welding programs or, and then trade schools with stuff. Any credentialing program that's recognized under federal or state law or under military credentials, you'll be able to take distributions out to pay for those. Permanent adjustments for inflation, which will affect the tax brackets and standard deduction. And then another change starting in 2026 for the American Opportunity and Lifetime Learning Credits, the education credits. The student's social security number is required. Okay. Oh, 1099 miscellaneous and 1099 NEC. Those amounts that have been static for a long time, it's like $600. Now they're going to get tied to inflation. So and plus they're going to get increased. Now, you may remember from our training, right, that the Form 1099 miscellaneous is used to report non-wage income that isn't covered by any other 1099 form. Those are like prizes and awards, rents, legal settlements, things like that. The 1099 NEC is the more common one. That's used to report non-employee compensation, such as vendor supplier payments to a consultant, a contractor, or freelancer. Now, big changes starting in 2026. That threshold that's been $600 for a lot of years will increase to $2,000, and then for 2027 and beyond, they're going to be adjusted for inflation. Be careful here, because we get lots of folks that come in here say, oh yeah, well, I made $450 doing this, but I was told I didn't have to report it because I didn't get a 1099 for it. We'll see that again and probably even more often, right? Because now the threshold in 26 is going to go up to 2,000. All income is reportable unless it's specifically excluded. Okay, just again, refreshing your memory from our training on income. This we're starting to see now in Congress because in 2026, the enhanced ACA credits expire. I won't go over the specifics of this. First of all, it's not settled. It's still, Congress is still kind of fighting this out. And secondarily, TaxSlayer will take care of these kinds of calculations. Okay. So changes for tax year 26 and 27, again, the repayment limits on Affordable Care Act tax credits will expire. So full payment of the advanced premium tax credit for households earning more than 400% of the federal poverty line. That's not a huge number either, I would tell you. The expanded eligibility expires. It eliminates the credit for lawfully present immigrants who are ineligible for Medicaid due to their status and whose income is less than 100% of the federal poverty line. Again, this is just to kind of give you an idea of these changes that are coming over the next year or two that were part of it. For 2027, there's going to be Medicaid work requirements. I'm not sure how that will affect us in the tax return, except it's going to affect our clients. Um, Again, I won't go over the details of this. Okay, this is kind of a good thing for the starting in 2027, there's going to be these things called scholarship granting organizations. These are going to be similar to like what we have for the Arizona tax credits now. And I'm really not sure how this is going to interplay with our state tax credits. But here there's going to be a tax credit of up to $1,700 for contributions to scholarship granting organizations. Um, this can be, but again, for the federal credit, it'll be reduced by any state tax credit that you get. Um, this is going to apply to public elementary or secondary schools. Cannot be used as a charitable donation because that would be double dipping. Although they could be carried forward, it's not a use it or lose it kinds of things. But then each state is going to have to elect to participate. And that's what I say. For Arizona, I don't know what's going to happen there. And again, they could qualify if the income is not greater than 300% of the area median gross income. That would be 77,000 for Phoenix. Okay, 28, what's going to happen there? Okay. Um, oh, and this has got a long ways to go. So although it is written in the law, right? But this is going to include a provision that would require all EITC applicants to obtain pre-certification that their child meets all the eligibility requirements for the credit. There has been a lot of abuse on the earned income tax credit. You know, claiming child, we said this earlier in the training, that claiming a child that didn't qualify. This is still a controversial measure because they tried it back in 2003 and it was really ineffective, burdensome, and IRS abandoned the practice. Um, you know, there's two sides of this, okay? But again, this is like 3 years in the making, 3 years before it's affected too. Um, you know, if this slide is talking about if they do have to put in that kind of pre-certification, it's going to delay refunds. IRS doesn't have the capacity to go through and handle that kind of pre-certification and documentation. Um, Although it's written in the law, there's still things could change, and so we'll have to wait and see here. So here's kind of a conclusion of all of this. So OB3, it preserves most of the 2017 tax changes. OB3 provides some additional tax cuts and credits for lower income households, at least for the next 4 years. It creates tax advantage savings accounts to give all children a financial head start. Those are the Trump accounts. And then the enhanced ACA subsidies. And I didn't say this earlier, but the enhanced ACA subsidies were the ones that came into effect during COVID. Those are the ones that are going to expire unless Congress does something, and they're working at it now. Okay. Um, there's other provisions, but they have nothing to do with the VITA program. Everything about that is out of scope. So that's it. We have a lot of sources that were used for these slides. One being, as we said, the Knoxville County Community Action Center, AARP Tax Aid, IRS.gov, lots of things. I've got another slide here too. Um, Trump accounts. These are all the things that we've used to try to put into these slides. And again, there's still going to be, we're at the middle of December now, and by the time we start VITA at the end of January, there's even still going to be some changes to this too. Okay. We've got IRS draft tax forms that we used in this presentation were there. And with that, that concludes this presentation. And our next video will be session 6. We'll probably try to do that all in one video because it's just kind of wrapping up some things, talking about customer service. I'll probably review the last parts of the certification exam and try to give you some tips on that. And so until next time, we shall see you later.